Welcome back to Finance Insider, where we break down the big moves shaping our economy. Today, we're diving into the controversial exit of Treasury Secretary Janet Yellen, the fiscal chaos she leaves behind, and what's next as President-elect Donald Trump nominates hedge fund mogul Scott Bessent to take the reins. Under Yellen's watch, the national debt ballooned to an eye-watering $36 trillion, fueled by a massive $1.8 trillion federal budget deficit. But it's not just the debt, it's she financed it. Instead of relying on long-term bonds, Yellen shifted to shorter-term treasury bills, which now make up nearly 30% of the debt, compared to just 15% last year. According to Robert Van Battenberg of the Bear Traps report, this approach was risky. Short-term debt needs constant refinancing, and as interest rates rise, so do the costs of this debt. Imagine refinancing your mortgage at a higher rate every 2 years. Sounds sustainable? Not for the U.S. Treasury. So, why would Yellen take this approach? Critics suggest it was political. By keeping interest rates artificially low during an election year, she avoided spooking the markets. Financing the deficit with 10 or 30-year bonds could have raised rates, impacting everything from mortgages to credit cards. But this financial juggling act may have just delayed the inevitable. Now, the short-term borrowing strategy has created a mismatch. Older, low-interest debt is being replaced by high-interest, short-term debt. It's a costly gamble, with implications for average Americans and the stock market. The fallout from Yellen's policies is already being felt. Inflation has strained household budgets. Higher interest rates have made home ownership less affordable, and the wealth gap has widened as the rich have benefited from rising asset prices. Meanwhile, the 10-year Treasury yield is inching closer to the critical 5% level, which could trigger a stock market correction or worse. If the bond market starts to anticipate even higher deficits or a need for longer-term borrowing, we could see a perfect storm: higher rates, declining stocks, and a major hit to investor confidence. And it's not just the Treasury Department facing challenges. SEC Chairman Gary Gensler announced his own exit recently, leaving behind what insiders are calling a minefield. His focus on climate disclosures and aggressive crypto enforcement has stifled innovation and morale at the agency. Whoever takes his place will have their hands full, just like the incoming Treasury Secretary. Scott Bessent, the hedge fund veteran, now steps into the hot seat as Trump's pick for Treasury Secretary. His challenge: stabilizing the economy, managing skyrocketing debt, and navigating a bond market teetering on the edge. Will his Wall Street experience save the day, or will the fiscal mess prove too big to clean up? One thing's for sure: Yellen's departure marks the end of an era, but the real test lies ahead. What do you think about her policies and the challenges facing Scott Bessent? Let us know in the comments below. Don't forget to like, subscribe, and hit that bell for more deep dives into the world of finance. Until next time, stay informed with